Hey everyone, thanks for watching. Continuing on our weekly theme of talking to experienced real estate investors, let's welcome Matt Seamus back to the show. How you doing, Matt?
Hey, Michael. Great. How are you?
Oh man, I'm doing great. Thank you again for doing this every week. It's a lot of fun, and I like our session. I joked last week about being the cleanup hitter, and you just crushed it. You cleared the bases, and it was because we just had a list or a series of topics to run through, and we kind of tied them together, and we got another list. So
Perfect. Let's do it.
let's do it. So the first one is, what do you think is the perfect first real estate investment? There's an interesting question for you. The perfect first real estate investment.
Yeah. Okay. That's a great question. I'm sure that's what a lot of people probably watching and listening are maybe thinking about.
Mm-hmm.
So I would go at this from a couple different angles. First of all, I think you need to kind of expel from your mind this notion of a perfect investment. It doesn't exist, right? I don't know. That's my opinion. I don't think a perfect investment exists.
Yeah.
Especially as your first real estate investment. I think taking action and getting out there, doing something, having a hypothesis, putting a plan together, executing against that plan, that is perfect in that it's a step forward, right? Are you going to double your money in 24 months? Maybe not.
Yeah.
Probably not. Almost definitely no.
Yeah.
But you're going to learn a ton.
Yeah.
And you're going to take a step forward that your peers that are considering making their first investment are likely not going to do. So I would say kind of get rid of that notion of perfect. It's not going to be perfect, and it shouldn't be. That's not a goal.
Yeah.
Go take action. Go do something. Go take a little bit of risk. Get uncomfortable. Put a foot outside. Put 1 foot outside of your comfort zone, and go see if you can make something happen. That's how I think about a first real estate investment.
Yeah. I guess when I read that question, I sort of keyed on that word perfect as well, like you have. I was like, well, really, what does perfect mean, right? Is perfect doubling your money in 2 years as you kind of went on? And for me, if I were to stay on that word, perfect first real estate investment is nothing to do with a return. Frankly, I hope you don't lose money, right? That would be bad. But perfect for me is it's in a place where you're going to find out if being a landlord is good for you, right? So for example, if you live in the Silicon Valley, I would be very opposed to buying something in Maine. I'm just trying to think of a state far away, because you can't learn you're 6 or 10 hours away from seeing it. You can't see it change. You don't know the area. I think a perfect first real estate investment has to be underscored, capital letters, italicized, something you can learn from, because you're either going to learn you like this thing or you're going to learn you don't like it and you can move on to something else. So yeah, for me, perfect isn't a return. It's a learning experience. I think that's what I think.
Yeah, I like that.
Okay. Oh, cool. I like it. I got one. Oh, here's one that I get all the time. How do you choose a market to invest in?
Well, you're not choosing Maine.
Yeah, I'm not.
How do you choose a market? Okay, so I can answer this from my personal perspective, which has been an evolution.
Sure.
So I'm in California. I'm in the Bay Area. I grew up in Stockton.
Okay.
So Stockton got absolutely crushed in the Great Recession.
Oh, yeah, like few others. Yes.
Yeah, that's right. I still had family there, and I was making pretty good money in my day job, and I had this itch to go start investing in real estate. And I felt like, I know Stockton well enough. It's one of those markets where you can be on the wrong side of the street, and you need to know that.
Yeah.
And I knew the neighborhoods well enough. I had, family ties there, so I had good connections. And so I just thought, I'm going to go try and pick up the worst house or the smallest house in a pretty decent neighborhood.
Mm-hmm.
I'm going to try and improve it. I'm going to try and rent it out. And my hypothesis was basically, I'm going to take advantage. I think I have a competitive advantage in that I have good relationships and I have knowledge of the market that maybe other people don't.
Mm-hmm.
And I'm going to go try and take advantage of that. I'm going to try and exploit the competitive advantage that I think I have. On top of that, this was driving distance from where I lived. Mm-hmm. And I had reasons to be going back and forth, separate and apart from, investing. So that's where I started. And I think that was, looking back, that was a great place to start for me. It was a low entry point in terms of price per square foot and just price to buy rental property. It was a great learning kind of ground. It was a great sandbox.
Yeah.
And so that's where I started. I did really well there. But for me, I realized I wasn't going to be able to scale.
Yeah.
And then as I got more sophisticated in kind of my mindset and my investing kind of posture, I realized I don't love the dynamics in this market the way that I probably would other markets. Mm-hmm. I don't like the fundamentals as much. I don't know how much upside this market has. And so I started looking outside of California.
Yeah.
And so I moved. Now what we do is we look for growth markets. Mm-hmm. So places where people are moving, where jobs are being created, where incomes are rising, and where the government, the municipality, the mayor, the director of urban and economic development, the people in charge are aggressively trying to grow. And the reason that we do that is we're out on the ocean looking to get on a wave. Mm. And we don't know what we want to identify a wave and then pick a spot on the wave and let the wave take us. And we can make improvements to our properties also, sure, which basically accelerate your path on the wave. But if there's not a wave to begin with, then we're going to be, to continue with this analogy, stuck in the water, right? So we look for growth markets. Yeah. We look for markets that are landlord and business friendly, sure, from a regulatory perspective. And we look for places where we either have or think we can create a competitive advantage through relationships, through knowledge of the market, and those kinds of things. So that's what we look for now. And that's kind of the evolution that I've gone through personally.
Yeah. So my evolution is kind of a one-step journey. The questions I had to answer before I put a single dollar down was basically once I realized the Bay Area, where both you and I live, was not going to be profitable to be a landlord. I needed to find my market, and I had to say, okay, am I comfortable getting on an airplane to go see my properties and go investigate the market, or do I have to drive? And I've been very clear, I'm a control freak. I traveled so much, I didn't want to see another airplane. So my only answer was I had to drive. So lo and behold, found Fresno, talked about it lots of times. But I've been asked, well, why'd you stay, right? To some of your comments, California is not landlord friendly. California is not business friendly. In fact, in the last 4 months, it's even less friendly on all accounts, right? Rent control and things of that nature. We haven't gone anywhere, right? We built up a portfolio, built up the team. We see too much risk going to others. We're probably too conservative. That's an opinion that's fair to be had. But if I were to look at a new market, it would be growing population, right? But that said, if you're in a market that's shrinking, even if you're in a market that's shrinking, but if you know it like you knew Stockton, you can still make a killing, right? You don't have to scale, right? I preach, if you just get 4 rentals, like 4 single family rental homes, you're going to fundamentally change your financial future. And you could do that in any market, So don't watch YouTube University and think you have to scale to hundreds or thousands of units. Your life fundamentally changes at 4 rentals. And that's okay for most of us. So, I have no plans of going anywhere else. We did dabble with Texas and Arizona back in 08, 09. But we're still growing in Fresno. Rent control is there. We expect it. You know, if they come after Prop 13 or something like that, it might be time to get out, right? That would be, if they took property taxes like Texas does on investment property and changed it to yearly evaluations, that would probably break my back and be like, all right, forget this state. You know, we're done. But
and I think the other thing, Michael, is you are, from my understanding, you are executing a pretty similar strategy with each investment that you make, right?
Yes.
The playbook that you execute.
Yes.
Yeah. So it makes even more sense with that strategy to stick to a market. It's expensive for you to go find a new market.
Oh yeah.
Right?
Expensive, risky.
Yeah.
You know, we don't want to turn, you know, in theory, right? We're, you know, in theory, right? We exited the rat race. We go to a new market. It's possible that market crushes us and we tip the apple cart that got us to where we are. So, you know, we are conservative for sure.
Yeah. Yeah.
All right, cool. That was fun. Passive or active investing, pros and cons of each. What does that feel like to you?
Okay, so there are definitely pros and cons to passive and active versus active investing. And
why don't you define what you think those two terms are, just so everybody's on the same page when they listen?
Yeah, so active investing would be you are in charge. You are making decisions. You are required. The buck stops with you. So, Michael, you are an active investor, right? You are identifying the property. You're determining how much you can pay. You're determining how much you want to renovate. You're probably selecting or overseeing the selection of the tenant. Etc. That's active.
Gotcha.
And passive would be if you, Michael, came to me and said, here's what I've done in Fresno. I got a great track record. I'm going to keep doing it. What I ran out of is capital. And I can give you, Matt, a great return on your money. I don't need your input. I don't need your decision making. You go to your day job, make good money, and give me $100,000, and I'm going to go turn it into $150,000 pretty quickly. That would be, I would be a passive investor in that sector.
Cool.
I'm relying on you, your expertise, and your elbow grease. So they're both great. I don't think they're mutually exclusive. I think you want to determine what fits your needs and goals and your lifestyle best. I think personally, I started actively investing, and that's what I continue to do. I do also passively invest. I personally passively invest when I want to go to a given market or a given asset class that I have direct access to. So it's a way for me to kind of diversify. And it's also a way for me to bet on someone else that I think is doing something really cool and interesting that I'm not going to compete with. So, but mostly I actively invest. And that's because I've chosen this as my career. And I'm very hands-on. I like to go get in there and do things myself. And I also feel like I have, a bit of a unique skill set in that I'm actually well positioned to execute well. So I started actively investing and continue to actively invest. I actually think, though, for many, many people, probably more people than individuals actually realize, passive investing is a great strategy because it's very difficult to maintain a demanding day job where you make good income and then actively invest in a portfolio of real estate on the side. That is very, very challenging. It's not impossible. And if you have the right motivation, and then you will get there. But it's not going to be a linear path where you just continue to get, it just gets easier and easier. That's not the case. It gets harder. And at some point you need to decide where is the best return on your time. So that's how I think about that question.
Yeah. So the definition, active and passive, totally in sync. So my thoughts on the situation. Is you have to know who you are, kind of what you want and where you are in your life. You know, are you in your early 30s working 70 hours a week, have 2 kids under 5, or 10 or whatever it is, and thus picking up yet another thing to crush your time, like active real estate investing, is probably not a great option. By active meaning flips and wholesaling and, evaluating deals and apartments and all of that. Do you want to be a buy and hold investor and pick up turnkey properties? That's probably doable, given I did it. So others can too. But there's parts of the real estate active cycle that probably aren't good for you unless you figure out how to clone yourself or extend the 24-hour day. I mean, it's tough. So passive is probably best for someone like that. But if you have the kind of job where it's kind of 40 hours and maybe, kids are out of the house, or you don't have kids, or you have the ability to carve out a couple of hours a day, and you have a desire for this to be your thing, to exit the rat race, go for it. I'm an active investor. Have I ever done passive investing? I don't think, no, I've never invested in someone else's deal, at least yet. So I definitely see the advantages of being active investors. I'm a control freak. I've said it 100 times. But there's definitely advantages to being passive. I've worked with dozens of passive investors who are like, nope, you got the track record. Let me know what you want. Back in 2010, it was thank you for the 10% interest only 5-year loan, which is what I was doing with folks. Today it's, hey, give me a little taste every month, so I'm interested, but also give me part of the profit. And they like that. So I think there's pros and cons. You just got to sit down and go, what do you want? What fits your lifestyle? It's really a lifestyle decision, in my opinion, I think.
Yeah, I think that's right. I think that's right.
Okay. Oh, here's one. I'm actually dealing with this right now. When do you refi? When do you sell? When do you return? What do you return profile are you looking for? What kind of return? What kind of return are you looking for?
Okay. Do you want to, since you're actively working through this, do you want to start?
Yeah, sure. So refi, we'll just break it down, right? So you got to think refi. First off, given we invest in different things, you have different, right? So if you're doing commercial, you have defined timeframes, right? You may have done an original purchase loan with a 3, 5, 7, or 10-year period. So those come with cliffs where a decision needs to be made, right? What do you want to do? So that's the first hurdle, right? Sometimes you are forced by a compelling event called a cliff or a reset or whatever you want to call that in the commercial paper. But I do single family homes a lot, at least, and that's how I got started. And for me, it was, the refi question was twofold. In the beginning, right, as I write about in the book, it was access to capital. I wanted to reuse capital to buy the next thing. I did not have a lot of money, right? I had 40 grand. I was able to spread that 40 grand over 3 purchases. I was lucky enough to invest in a market that had crazy appreciation. So I went back to the well and turned that 3 into 8 via cash out refis. So that was question number one. I talk about in the book, I over refied my first house because I turned it from positive to negative cash flow. I call it an alligator. So don't do that, right? Don't take all the money just because the bank says yes. But so I had a purpose. One thing about refis, when you're doing your rental stuff, is the only reason you do a refi, to cash out refi, is to buy another asset. Don't buy toys, don't buy trinkets, don't buy doodads, don't live fancy, right? Don't stop the momentum. And then recently, so that was the first time, recently I've done rate refis. So I had some private money, as I talked about earlier, at 10%, but they were really small loans. But recently I was able to go back and get bank loans. So I was able to take 10% down to 6.5%, and we rejuggled debt. So we took a bunch of 10% debt down to 6.5%. We paid off some 10%. So now we have assets owned free and clear. We levered up on others. So I only refi with a plan. And a plan, I mean, like an immediate plan. I don't enjoy the paperwork process. I don't, I have a plan for the next step. It's never a single event. So that's what I think about refis.
And how about return profile? And when do you, if you have a property that you are, let's say you can pull out 100% of your cash.
Okay.
You're still cash flowing.
Yep.
Or you could make probably even more than that on a sale if you decided to sell it. How do you think about selling a property versus holding it, refi, taking cash out and just holding on to it?
Oh, it's always the second step. The selling or the refi is, I don't know. I don't like using sport. It's just the first, I haven't moved yet. My question is, what's the opportunity cost? I'm not going to start a refi or list something unless I already know what I'm doing with those proceeds are fun. Right. So the question becomes, is this a good 1031 candidate? Because I'm going to move all of the equity into an asset with a higher potential yield or value add or more units or better part of town or whatever. Or it's, hey, I'm going to refi this debt. I'm going to keep my cash flow because I'll never, ever make that mistake again. I'll never turn another asset negative. I will not do the deal if that happens. And can I take that capital and go deploy it elsewhere? I don't really have a hurdle rate. I'm still growing the portfolio. But again, it's one rental at a time. It's small multifamilies. So yeah, I always think about the next step. And then what I usually do now is I go find the thing, right? I go find the asset I want to buy. And then I decide what is the cheapest way for me to buy that asset. That's actually how it happens. I never look at the asset I own. I find an asset I want to buy and I go, okay, do I want to use cash? Do I want to use private money? Do I want to use one of my other assets that has low debt or whatever? That's actually what I do. I don't think about the asset I own. I think about the thing I'm buying, if that makes sense.
Yeah. Yeah, no, it does. So I used refinancing extensively and still do, also, especially with single family homes.
Yeah.
And I started, this may be a little nuanced, but I started taking out 30-year fixed rate loans on the purchase.
Sure. Makes sense.
And then I was buying houses and triplexes and duplexes that needed, some significant work.
Right.
So I was doing some pretty extensive rehabs. And at the end of the rehab process with a tenant in place, I was creating, meaningful amount of value. So it made sense to refinance and capture some of that value.
Yeah.
So I actually started transitioning from, I was taking out 7/1 ARMs instead of 30-year fixed loans because I knew I'm going to refinance this thing in 18 months anyway.
Right.
And the interest rate on a 7/1 ARM was significantly lower than a 30-year fixed, at least at that time.
Yeah.
So I got a little bit nuanced in how I was thinking about debt.
Well, your strategy was, it wasn't called it then, right? We didn't coin it, Bigger Pockets did, but it was just a BRRRR strategy, right? That's what you were essentially doing. Yeah.
That's exactly right. Yeah. I didn't know that term, you're right. It didn't exist then, but that's exactly what I was doing.
Right.
And so refinancing was always an important part of of just kind of the strategy.
But again, you knew that before you signed on the dotted line, right?
I always knew I'll give you an example. I'm going to buy this house for $123,000. I'm going to put 50 grand into it. It's going to be a brand new house.
Right.
So I'm going to be $175,000 into it. And then, sorry.
That's all right.
And then I'm going to, sorry about that.
That's okay.
And then I'm going to be 175 grand into it. It's going to be a brand new house and it's going to be worth, call it 225.
Okay.
So I just created $50,000 of equity. Well, that equity is not doing me much sitting in the backyard. It can be really helpful if I pull it out at a low fixed interest rate. And like you said, go find another property to invest in.
Now, one sec. So on the refi, I totally get 7/1 ARM, 3/1 ARM, whatever you wanted it to buy because you had that plan. When you did the refi out, did you do a 30-year fix at that point?
Depends. Depends. So
why does it depend?
Because I started realizing that if I can get I would always do an analysis. So there wasn't an easy answer. Okay. I would always look at what's a 5/1 ARM, what's a 7/1 ARM, what's a 30-year fixed, and try and compare what I thought the most likely. I would try and get to a probability weighted outcome. How likely am I to hold this property? Let's say the 7-1 ARM was 3.5% and the 30-year fixed was 4%.
Right.
I would try and project how likely is it that I will want to sell or refinance this property in the next 7 years.
Okay.
And
Yeah.
the more that I executed this strategy, the more I realized by recycling my cash quickly, I'm actually able to accelerate my purchases and my goals.
Yeah.
And so I started leaning heavily towards the shorter term adjustable rate mortgages, which had lower interest rates because it increased my cash flow.
Sure. Of course it did. Yeah.
In some cases, the lender is actually cheaper to originate the loan.
True.
A 30-year fixed, because in some cases they're keeping those in-house as a portfolio loan.
Yep.
And it just felt like the right strategy for me.
I think of making that evaluation strategically as part of your business model is absolutely the right thing to do. I never did, right? I was like, nope, 30-year fixed. That's all I ever want, right? My only question was, do I want 15 or 30? And I was young enough where 30 was the only answer. But I will honestly admit, I never ever considered, I just assumed I would own these things forever. I just didn't know any different. I wasn't trying to build some massive empire. I was like, man, if I can just get one more, I'm gonna be better off. And it just kept growing from there. So
which is right, that's accurate. Like we're splitting hairs here a little bit. These are optimizations.
Sure.
And these are a little bit nuanced. I wouldn't expect a first time investor to be thinking about this, and do not hold yourself up by thinking about these things.
Yeah, that's a good, that last point's a great one, because I could just imagine the people's Excel spreadsheets going nuts trying to calculate a weighted average. I'm like, no, stop, just do one deal.
No. I think very analytically.
Yeah.
And so that's just how my mind works.
Yeah.
So that's how I did refinances, especially early on.
Yeah.
Now we have a very similar strategy with commercial and multifamily properties, where we buy something in a growing market when we have a really solid plan to add value to the property. So by definition, we believe that, call it 2 years down the road, after we've executed our business plan, we are going to have created some value.
Yeah.
Now we need to capture the value somehow, either through a sale or through a refinance. And so we are constantly looking at weighing those two scenarios. In fact, we have a property right now that we're weighing this decision on. And we sell it. We will probably return, I don't know, somewhere around 40 or 50% to our investors in 18 months, which is really good for them.
Yeah.
If we sell it, we will do a 1031 exchange. We will transfer those proceeds into a new investment property.
For sure.
If we refinance, typically you don't get as high of an appraisal on a refinance.
True.
So very you true. Actually leave some equity or some cash on the table.
Yeah.
If we refinance, then we like to be able to pull out the majority of our equity.
Yeah.
And return it back to our investors.
Yeah.
And then your cash flow may come down a little bit in terms of raw dollars.
Yeah, raw dollars. Yeah.
But your cash on cash return can skyrocket.
Yeah. And
so that's how we think about it. There's no silver bullet. Yeah. It takes some analysis. I think one thing to realize is if you are deciding between selling or refinancing, these are both, and you have equity that you're going to take out, made a good return. This is a high quality problem.
Yes, first world problem.
Yeah, this is great. This is a moment to celebrate, even if it's a small win.
No, I agree. Not enough celebration going on. I totally agree with that. Yeah, this brings us to that second question: is when do you decide to sell? Again, for me, right, building our personal portfolio, I never thought I would sell. However, now after 20 years, I have realized that there are moments in time, like Warren Buffett says, where people will overpay. And when I sense a frenzy market, I will get the heck out of the way. I did this in '06 and profited it handsomely. And I'm on record in the last 12 months of selling some less than high quality small multifamilies because people are just overpaying. So anytime somebody wants to overpay for something I own, it's for sale. And I will just move the equity somewhere else, most of the time via 1031 exchange, so I can delay taxes. But there was one building I sold, given my cost basis and how I was carrying it, that I actually just took the cash and I'll pay a little, I'll pay 15% on, a pretty small percentage of profit. So that's the only time I even consider selling, is when somebody wants to pay meaningfully more than I think something's worth.
Yeah. And I think that's right. I mean, you need to think about, let's say you bought a multifamily property for $500,000.
I have actually exactly that number.
Okay. And so let's say now someone's willing to pay you $1 million for it.
Yeah.
And you say, well, man, I wouldn't buy this for $1 million. By holding the property, you actually are making the decision to buy it effectively for $1 million. If it's worth $1 million and you can sell it for $1 million, then you're buying it.
Yeah.
So I think it's important, or at least for me personally, to very constantly look at, what do we think this property is worth? Are we buyers at today's price?
Yep.
What's the opportunity cost of this capital? Can we go find a better opportunity somewhere else? And that leads to being a little bit more active in terms of making trades.
Yeah.
And that's the mindset that I have.
Yeah. I watch the market, and the market then tells me what's being overvalued. And again, it's very rare, right? I've been doing this 20 years, and there's only been two kind of peaks that I have sensed. And again, I freely admit I'm wrong all the time. So who knows? You can't argue with the success in '08. You can certainly argue my opinion in 2020, but we'll see in 2022 if I'm right or not.
Yeah.
But yeah, again, for me though, this is how I pay my bills, right? So selling off an asset to raise a bunch of cash doesn't do me any good unless I can deploy it elsewhere.
Yeah.
Pretty cool. I like that question. That was fun. What's the worst real estate investment you've ever made?
Okay.
I'll go first while you think about it.
Yeah.
So back, I want to say it was 2005 or 6. I don't remember the year exactly. It might have been late 4. We found a builder in our market that was doing model home sale leasebacks. Right. So we bought a home. I don't know. I don't remember the exact number, but call it $300,000. And in my market at that time, $300,000 was a very nice home. I think the median back then was probably 180, right? So 300 was way above. And I wouldn't do this deal today, but this is why the lessons learned, right? So what we got attracted to is the builder was going to lease it back from us for 2 to 2.5 years. And they were going to pay roughly 2x what we considered the rent rate, right? So we buy it for $300,000. Our mortgage payment, I don't remember exactly, call it $1,100. They were going to pay us $3,000 a month to lease this model home back from us. So that worked out really, really well, except when the time came up.
Almost too good to be true.
Almost too good to be true. And then we roll into 2008, and suddenly the builder vanishes because they can't sell any homes anymore, and the tract home is only half developed. And yeah, sure, we have a model home, but it's surrounded by a bunch of dirt lots and half-built houses. And that was painful. Actually, we still own it. That's still painful. But finally got rebuilt out. New builder came in, but that was after freaking 8 years or something. It's finally coming around. But yeah, lesson learned from that is, and people will hear me say it now, is I don't buy above the median, again, because I'm a affordable home person. Right. So my market today is 260. This home is still the nicest one we own. In fact, it's the only one we'd ever consider living in, is how nice it is. But yeah, so what do I do now? I don't buy those. I don't buy above the median. I don't do model home leasebacks because builders can disappear and you have lots of legacy risk. And yeah, that was a painful lesson. I thought I'd figured it out, and boy, did that crush me.
Yeah, that's interesting. So, and I think you hit on the most important thing, which is like actually the lessons come from the failures. The lessons come when you do something that you will never do again.
Exactly.
And I'm sure if you think about it, there are the first order lesson you mentioned was, well, I'm never doing a model home sale leaseback again.
Yep.
But then there are second and third order effects that you learn from that lesson that probably are still informing your investing today.
No question. I don't buy above the median.
Don't buy above the median. You probably assess risk on new developments very differently today.
Very differently.
So I think this goes back to our first topic, which was what's the perfect first investment? I mean, I think you need to get in there and do something, get your hands dirty, learn, because you're not going to develop that knowledge base without little failures.
Yeah.
And especially on single family homes in a market like Fresno or Stockton, where let's say the median is 260, you're not going to hurt your financial future by having by having a deal where you learn, but you don't make money.
Yep.
The risk is relatively, you're bounded.
Mm-hmm.
So, okay, my worst investment, it was probably my first deal.
Okay.
It was probably my first deal. But again, like the most learning of any deal that I've ever done. First deal, I bought a single family home for $110,000. Decent neighborhood. The house was in okay shape but dated. Nice size lot, very rentable. But I didn't know anything about inspections or due diligence or what to really look for. I didn't know what it meant that the house was built in 1960 and we had original cast iron
pipes.
Right? So I buy the house, we get a tenant, and we do some minor renovations. And we hire a contractor. He doesn't perform what he said he would. I paid him in advance for things. Luckily, I paid him on a credit card, which was helpful going back to dispute later on. He lied about several different things. So I wasn't there physically to be on top of things. That was a learning opportunity. So that was the first debacle, was understanding, man, someone can really hurt you if you trust them more than they deserve to be trusted, and you pay them in advance. Mm-hmm. And so I went away. We got a tenant in place. I went away on a family vacation out of the country. And literally the weekend the tenant is in place, they call me and say, hey, the bathroom is flooding. The bathroom's flooding. So I'm in Mexico on family vacation trying to deal with a flooded bathroom. And we ended up having to replace the main sewer pipe under the house. And it was just a cost that we were not anticipating. And so I learned the importance of inspections and due diligence and really understanding what you're buying before you sign on the dotted line.
Yeah.
The house ended up being a great overall project. It made good money. It appreciated in value. We forced value into it by improving it. The tenant stayed there for a long time. But there were lessons early on that I learned that I will never repeat those same mistakes.
Yeah. That's awesome. It's fun. It's really nice to have a lessons learned and you make money. That doesn't always happen.
That's right. Yeah.
Well, Matt, I know you have to go. We're running right up to your time frame. I appreciate you. Thank you for doing this, and we'll do the next one.
All right, Michael. Thank you. Appreciate it. Have a good one.